Klarna has been one of the biggest fintech IPOs of this year, currently being valued at close to $17 billion as of this recording. However, despite having over 150 million active users, this might be one of the worst IPOs for retail investors to invest in. I built a 10-year forecast for revenue and free cash flow, and my fair value comes in at $33 per share, suggesting that the stock is trading at a 35% premium, meaning that the stock is significantly overvalued. In this video, I'll explain Klarna's business model, then walk you through its financials, break down the bull and bear case valuation, and expose the hidden risks we as retail investors need to know about before investing in any IPO. So yeah, let's dive in. And let's start off with a quick snapshot of Klarna as a company over the past year. We can see that revenue has grown by over 20% and EBITDA is finally positive, and in 2024 the company had an EBITDA margin of 2%. Now the current share price is $45, roughly 5% above from where it opened to the public market, and also the company is headquartered in Stockholm, Sweden. So what makes Klarna stand out? Well, unlike traditional credit card providers, Klarna built its reputation on buy now, pay later, splitting payments into installments with no upfront interest. It became a fintech darling here in Europe and expanded aggressively into the US, partnering with retailers like Nike, H&M and Walmart. And today, Klarna also positions itself not just as a payments player, but also as a shopping ecosystem, with its app blending e-commerce discovery, financing and rewards. Klarna claims this creates a stickier customer experience compared to pure payment providers like PayPal and Affirm. Now, financially, Klarna has shown rapid top-line growth. They've been cutting operating expenses as a percentage of revenue from 151% in 2022 to just 104% in 2024. But the business model still raises major questions about profitability. So to better illustrate my point, let's do a quick quiz. So the question is, by how much do you think Klarna has shrunk its workforce over the past few years? Is it A, 17%, or B, 33%, or C, 59%? Well, the answer is actually 59%, and let's take a look at a short clip of Klarna's CEO presenting this data.
We haven't hired people for 2 years. We've shrank the company from 7,400 to 3,000 people, which is fantastic. But I would say we probably over-index a little bit on efficiency.
Now, there are a few red flags from this video. First of all, stating that cutting its workforce by 59% as being fantastic isn't a good image in my opinion by a public CEO. In addition, despite of all of this cutting, still having operating expenses that are higher than its revenue is another big red flag that we as investors need to think about before investing in Klarna. Now, of course, it's not all bad. We have a bull case as well. First of all, Klarna has over 150 million users globally, and it's the top player in buy now, pay later, a segment expected to keep growing as consumers seek alternatives to credit cards. In addition, Klarna has partnerships with big brands and e-commerce players, giving the company strong distribution and transaction volume growth potential. Now, despite of this, we have a strong bear case as well. Klarna's buy now, pay later model is stuck between two tough choices: chase market share and burn cash, or shift toward profitability and risk losing users to competitors. In addition, we have rising competition. Players like Apple Pay, PayPal and Affirm are crowding the space, while traditional banks are also moving into the market. And lastly, we have overvaluation. Even under optimistic growth assumptions, the stock is priced at a hefty premium, leaving little upside for us retail investors, which I'll talk about more later on. Okay, so now I have a sense of what Klarna does as a company. Let's take a look at some historical financial data, and it's actually really hard to find consistent financial data about Klarna online. That's another red flag, but I've done the best to find 3 years of data, so going back to 2022 all the way up to 2024. And here you can see basically the core financial performance of Klarna. We can see revenue in blue and we can see the EBITDA in green. Now the good news is that revenue is growing consistently at 19% per year, and EBITDA is at the same time just turning positive in 2024. So the CEO is correct in that sense that the company is growing and it's becoming much more efficient and profitable at the same time. Now let's also take a look at the debt sustainability within the company. We can see here the debt in purple and we can see the excess cash as green, right? So it's quite obvious that yes, debt is no risk at all for us as investors, as the excess cash is much higher than the debt, right? It has also grown by 36% per year, which is also good news for us as investors. Now, as we also will use the free cash flow in the valuation later on, let's take a look at the free cash flow performance. Now here we can see the revenue in blue, and instead of the EBITDA we can see the free cash flow to equity, so that's the relevant free cash flow to us as equity investors. And yeah, we can see revenue has grown and free cash flow has become positive in the past 2 years. That's good for us as investors. Now I do believe that these free cash flow numbers have been slightly inflated, so I've adjusted it down for my forecast going into the valuation later on as well. Now the final chart I have to show you has to do with the share performance of the company. Now this is slightly different, right, because this is a new IPO. So we can see the current share price here below at $45, and we can see the current amount of shares outstanding in millions in the company right now at 378 million. Now before the IPO it was 344 million. Now this is also something that I don't think is a one-time thing. I think the company will increase the number of shares in the company each year and continue to dilute shareholders, which I've also included in my valuation estimates. Okay, so let's move on to the exciting part, which of course is the valuation part. And I'll start off by going through all my estimates that I've used in my forecast, just to be fully transparent on what I believe is an optimistic scenario for Klarna stock going all the way up to 2034. So that's 10 years including 2025. And starting off with revenue growth, here I'm assuming 16% per year. That's slightly lower than the 19% we've seen on average in the past 3 years, which makes sense as the company will grow, right? Revenue growth will also slow down. Now, in terms of EBITDA margin, I'm assuming 25%. This is a really optimistic assumption, as in the past 3 years it's been minus 12% on average. And finally, in terms of enterprise value to EBITDA multiple, I'm assuming 12 times, and that's lower than the historical average. As the revenue growth will slow, the multiple will also compress, of course. Okay, so let's move on to free cash flow growth. Here I'm assuming 19% yearly growth rates, and that's higher than the revenue growth, assuming that the company will become much more profitable. In addition, I'm assuming a free cash flow yield of 5%. That's how much free cash flow we get relative to the share price. And finally, I'm using a discount rate of 11.3%, which is quite generous for a type of company like Klarna, which most likely will be quite a volatile stock in the market. And yeah, here you can see a complete overview of the revenue and the free cash flow that I'm forecasting for Klarna all the way up to 2034. Now, it's important to add that yes, I'm assuming higher rates of growth for free cash flow than revenue, as the company will become much more profitable, at least according to themselves. Now, in addition, you have to keep in mind that the growth of this company will not be as consistent as you can see here, right? There will be peaks and there will be drawdowns in terms of growth. I've also decelerated growth for revenue and free cash flow as well, all the way down to 2034 in order to be conservative. And as I showed you in the introduction, if we discount all of those future free cash flows to a present value of today and get a fair share price, we get it at $33 per share, suggesting that the current share price is trading at the 35% premium. This also implies a 12% annual return for the stock going all the way up to 2034. And this basically shows us that even with optimistic growth and profitability assumptions, that the stock is indeed overvalued today, at least in my opinion. And to showcase how this optimistic scenario could pan out, here we have a waterfall chart showing the cash flows for us as investors. Now, of course, we have to invest in the stock today. We get some free cash flows for 2025. Then we get free cash flow each year, right, as dividends or share buybacks or what have you. And then we sell the stock in 2034. And it's basically the total gains relative to the stock that we have to buy today that gives us the 12% annual compounded return that I showed you earlier. Now, if you, just like me, believe that the growth assumptions in the bull case are too optimistic, let's take a look at the bear case as well and see what happens to the fair share price if our revenue growth and free cash flow growth assumptions are lower. So in this bear case, I'm assuming revenue growth at 9% and free cash flow growth at 10%. Now with these new growth rates, we get a fair share price of just $16.7 and the annual return drops to 1%. This also shows us that the current share price is then trading at a 173% premium, so it all depends on you as an investor and where you believe Klarna could perform. So what's my strategy when it comes to Klarna stock? Well, I'm obviously not going to invest in the company, at least not today, but here we can see a comparison of where the company is in terms of its business quality and its valuation relative to other stocks I've covered in the channel. Now, ideally, we want stocks in the top right that are both undervalued and great businesses. Now, I'd actually place Klarna here, right? I think it's actually overvalued and it's a weak business. It has heavy competition and it's also not profitable at the same time. Now, in the best case, Klarna could move up, right, to a higher position in terms of valuation, but the business quality will be the same, right? It really isn't a great business like Visa, Microsoft or ASML. Now, a great stock, in my opinion, isn't only a great business and that is also well priced in the market. It needs a third element as well, which I call momentum. So yeah, let's take a look from a technical point of view if Klarna has any momentum today. Now here we can see the stock chart of Klarna, and of course the company hasn't been public for that long, so it's quite limited in terms of the technical analysis we can do. Now what we can see is that the stock has followed the same trend as most IPOs, right? We see huge excitement in the day of the IPO where the stock price goes up and then it usually falls flat in the next few days. Now in terms of Klarna, the stock has stayed quite resilient, right? Staying close to the same price as it opened up on its IPO at roughly $45 per share. So I guess this is another risk of going into Klarna stock today, right? We don't really have enough data, historical data of the stock chart to do a proper technical analysis. If you invest in stock today, the stock could bounce 50% or it could go down by 50%. Really no one knows, and there is no technical analysis that could help us predict the future share price of the stock as well. Now, if you are interested in investing in Klarna today but would like a more attractive price, here you can see what happens to the annual return if the stock price goes down. That's good for us as new investors. Or if the stock price goes up, currently at the share price of $45, we are at 12% per year, which isn't that good for this type of company with high volatility and high growth expectations. However, if the stock would go down by 30 or 40% and reach my fair share price at roughly $30 per share, then the annual return increases to 18 to 21%, which is much more attractive for this type of company. Now, of course, Klarna comes with a lot of risk today, being a new IPO and a company that doesn't really have any profitability at all. So I, as an investor, would look at a heavy discount versus my fair share price before even considering investing in Klarna. And for me, that's actually below $20 per share, which is more in line with the bear case that I presented before. Now, given the premium that the stock is trading at today, I've given the company a sell recommendation and just 2.5 out of 5 stars as my final rating. And yeah, here you can see all the key considerations that have gone into my final rating of Klarna. Now, where the company hasn't scored that well, of course, has to do with the inconsistent stock performance. It's of course a new IPO, so we'll see with time if the stock is consistent. And of course, the company is overvalued in my opinion. However, where the company has scored the worst has to do with moat strength. It doesn't really have a strong competitive positioning. And finally, there are quite high macro risks. If the global economic environment worsens and people can't pay back the debt that they take on Klarna's app and cards, then that's a huge risk for investors in Klarna stock today. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. So yeah, thank you, and I'll see you in the next one.